Good afternoon from the Shreveport office of Eagle Financial Management Services for the last Jack and Bill show of 2021. We are here in the office today during a federal holiday. This is actually the 13th time the stock market has been open during a federal holiday since 1928, I believe I saw, Bill, and we really don't appreciate having to be here today.
No, and it feels like it's 80 degrees.
And it is. It's probably pretty close to 80 degrees in here, which is quite unusual for even cities in the Gulf South this time of year. It's been a very warm Christmas. So this is also...
No, Wes, it's not menopause.
This is also the first time that the market has been open during the FBS college football playoff games. And the first kickoff is in 13 minutes, Bill. So you're going to have to talk quickly. We've got Alabama taking on Cincinnati. Cincinnati being the first university not amongst the Big Five power conferences that has made a playoff game. The line is 13. I'm going to have to pick Bama and much more than that. And Georgia and Michigan, numbers 2 and 3, are following shortly thereafter at 6:30 Central. So 2021 markets in review. Hopefully we have a special show for you today. The S&P 500, it looks like that the Dow has, we still have 45 minutes to go here. So the markets are kind of mixed back and forth, very close to break even. If we were to close right where we are now, the S&P 500 would close up 27.3% for the year on a total return basis. That's with dividends reinvested. The total stock market is up 24.44% approximately. That's a little bit less than the larger blue chips in the S&P 500. The total stock market includes smaller and medium-sized market capitalizations, as well. It's been an interesting year. I mean, just looking at what stocks did across the board, doing terrific. But you had to be in the right ones and at the right times. Like I was looking, we had Ford Motor Company break out today and make highs for year to date, last 12 months. Doing terrific. Yet you look at the airlines, actually, if you were positioned in the airlines on January 1, you lost money, this year. Of course, the big question is where are we going from here? Would you rather own Ford during 2022, or would you rather own, Delta Airlines? Or would you rather own Pfizer? Or would you rather own tech? So silver and gold, surprisingly, a little bit surprising to me, these metals were down 14% this year and 5% this year, although both of the metals up today significantly. Bitcoin continuing to roar, up about 66% this year. And that's in spite of, a downturn in the last month. So a big story of the year that we've had has been tied to inflation. And then the big question there is, how much of this is transitory and how much of it has not. So the Dow Jones Commodity Index had fallen off a little bit recently, but has really been roaring back, up 30.4% year to date, with oil and natural gas leading the way. Bonds were up today, but bonds were largely negative on the year. They were way negative in Q1, Bill, and then kind of fought their way back. We had a steepening going on with higher higher yields, dramatically higher long-term yields in the first quarter, and with Delta and Omicron, we've had a reversal of that with both a decline in the level of most yields, but a flattening as well. And I take that back because we started out with the 2-year Treasury note yield around 0.25%, and that has tripled to about 75 basis points, with the 10-year at 1.5 and the 30-year just a tad below 2% at 1.91. So Bill, what did we want to discuss, or continuing in this conversation? I see you have some tips for our viewers to ponder and posture here at year end.
Well, I do have a thought as you were going through notable asset performances over the year. We're marking performance on a calendar year basis, and that really doesn't tell the story because, like for example, Bitcoin, up 60% year to date, but it's way off its highs. And when we're talking about like the interest rate environment, yes, we saw the steepening happen, and then we got into the springtime and we saw flattening. We saw the reopening and value stocks do really well first part of the year, and then we saw commodities and value and reopening stocks settle in and trend down in the latter part of the year. So, there's a lot of things going on intra-year that we need to pay attention to. But basically, it was a good year, and for a lot of things, broadly, stocks, but the markets just did what they did. And I know a lot of people are feeling pretty smart, little smarties, because shoot, the market was up 27% year to date. But even though we may feel smart based on how we did this year, we can't rest on our laurels, and we can't be complacent here because things do change, and we've seen things changing intra-year. So I would say be careful here, because you might find yourself being a dum-dum if you don't, at a minimum, rebalance your portfolio. So for those people who have a mix of stocks and bonds, so you have two different asset classes broadly in your account, your portfolio. Well, what you've seen with the conclusion of 2021 is that your stock allocation has now grown much faster than your bond allocation. And you can let it run. You can play the momentum game and let your stock winners run, and let your bond allocation as a percentage decline as your stocks outperform your bonds. But there really is an advantage to doing some periodic rebalancing, and it kind of goes against, it's counterintuitive. It goes against our thought process because you're having to sell things that have done well. And a fallacy for investors is that we look at that which has done well, and so we like those things that have a good track record. I mean, who wouldn't like the S&P 500 after a 27% return this year?
Yeah, Bill, I'd like to throw in there. We spent all of this week looking over accounts to realize unrealized gains. Losses that would offset gains that we realized during the course of the year, and
rebalancing in the process.
But I noticed we had very little. Almost every security in our client accounts are up. So although mutual funds, 40 Act funds are required to, and closed-end funds, pass their realized gains on to investors each year, and they do that typically declaring future distributions in October, November, distributing them in December. So they reduce the share price by the amount of the distribution and pay you out additional shares. And so then it looks like the share price has fallen,
Mhm.
and you might have the appearance of a loss when you actually have a gain.
It's
And
so you
so
don't get double taxed.
exactly. And so but that was a way to prevent some of our shareholders from having to pay more in income taxes by, realizing some
Mhm.
losses to offset those gains. But, I'd like to throw one other thing because I had the rebalancing. You have a year where stocks go up 27.3%. And I would say in January, if you had said the S&P 500 is going to go up 10% this year, I think I would have taken that right then, you know, uh, given everything that's happened with the pandemic and so forth. So if you have an account that's 50-50 stocks and bonds, you know, that's significant rebalancing to go from up 27 in stocks, and conventional or traditional bonds like treasuries lost money.
Yeah.
So you would have to, but we've talked to our viewers about this, Bill, and I just mentioned there a 50-50 portfolio, or one of the ones that's an allocation of 60% bond stocks and 40% bonds is a really common kind of long-term historical moderately conservative allocation. And we really don't care to rebalance into 10-year treasuries paying 1.5%, that if interest rates at that yield level go up 1%, your investment is worth 10% less. So where bonds historically, or government bonds especially, have been thought of as low risk, we don't view that as the case anymore, especially with the inflation, that we've had. And so we've gone from the traditional 60-40 to more like a 60-20-20,
Mhm.
where we own right now and still love them. Um,
Is that your wife?
Sorry, that was my wife calling me, forgetting that we're doing this. But we own alternatives to stocks and alternatives to bonds. And very simply, if you think again of what is an alternative, if you own cash, own stocks, and own bonds, now think of everything that you can't put in those three
Mhm.
categories. And the definition is evolving and always changing. But we did especially well during 2021 in our alts, whether they were business development companies that are adjustable rate loans and in a diversified fashion. We had some high quality ones that did terrific in each of the last 2 years, even through the pandemic, to algorithm run strategies within the 40x space, that take advantage of trends with commodity prices. We own a fund there that has made about 30% since coming out of the pandemic, mid last year. Anyway, I interrupted you.
No,
Yeah,
that's fine. I mean,
yeah,
what you're saying about treasuries or just traditional bonds in general, yes. I mean, it's not a good income play. I mean, yields are so low, and given where we are with inflation, I mean, you're looking at a negative real return on traditional bonds, so that's not appealing. The only reason why anyone would buy, traditional treasuries or traditional high quality corporates is if they want a hedge on equity market risk.
yeah.
That's really about it. And then you also have banks and insurance companies that need to buy treasuries because of regulatory requirements. But anyway,
I'd like to add to that, though, Bill, because we've talked about this on prior episodes, but and we really don't own long dated, treasuries. I think that's one of the worst places to be. I actually think that's a market that is ripe to blow up, especially with inflation where it is. But historically, you say, well, the stock market makes me nervous. I don't like policies that are going on in Washington. I'm a little scared about Omicron. And so let's own some long dated bonds, but we could be in a place where stocks could sell off and bonds could sell
Mhm.
off at the same
That could
time.
happen.
And that really hasn't happened in a long time.
No.
You'd have to go back to the 70s, really, 1966 to actually 1982 was a long period in the stock market where the Dow Jones reached 1,000 in 1966 and was at 1,000 in 1982. I remember the cover of Business Week News magazine. It was entitled "The Death of Equities," and of course, that's when the great bull market that we're in, really took off again. But a common theme potentially regarding the period that we're in now versus that time period could have to do with inflation and accompanying higher long dated interest rates. So,
Yeah, I mean, we'll see. We'll see. I mean, we don't know. We don't hold the crystal ball when it comes to interest rates, but we shall see. The main thing is what we were discussing earlier, and that is the importance of portfolio rebalancing. And we all have things in our portfolios that have done exceptionally well. And we cannot, as I said earlier, rest on our laurels and just continue to assume that which has done the best will continue. So look at your portfolio, reevaluate, get some help. We're here to help. And that's just one of the checklist items that we encourage people to go through as we're approaching year end. There's some other things, that are on my checklist, like, okay, take your required minimum distributions from your retirement accounts.
you've got 30 minutes
You
to
got
do
30 minutes. So
that.
if you haven't, sorry.
Or you've got today. You can
No, you
still
got
do
today.
charitable contributions today.
You better hurry up.
Yes.
So you may miss out on that too. Sorry. Tax loss, you were talking about that. Well, you've got 30 minutes to take care of harvesting tax losses. So for most people, sorry, we've already done this with our clients. But here's some other things that everyone needs to be taking a look at, or should be, and you don't have to do it today. This is just a good time of year to think about and review. Like, for example, look at your insurance policies. Any type of insurance. That could be annuities, life insurance, health insurance. Review your elections. If there are beneficiaries, like on annuities or life insurance, review your beneficiary elections. Things change. You may have married,
Absolutely.
divorced, you may have children. So this is a good time of year to review all of that. Something else, for people who have larger estates and have estate plans to help them in preserving their wishes for their beneficiaries and minimizing estate taxes. This is a good time of year to review that. Review it with your CPA. Review it with your attorney. What are some other things you think of?
Well, retirement plan contributions.
Oh yeah.
Okay. So
Yeah.
those really don't have to be in by the end today. I mean, generally you have up to the tax filing deadline to make contributions for this calendar year that's ending. I mean, generally that's April the 15th, but if you file an extension, you can make simplified employee plan contributions and even simple plan contributions.
Well, that's right. I mean, we're
Yeah.
working with a number of clients, business owners, who do not have a company sponsored retirement plan, and they have until the tax filing deadline to
Yeah.
make their 2021 contributions. So this is a good time to talk to a financial professional to review small business retirement plans, because if you're a small business owner, you could have a retirement plan. Even if you're the only employee, you could have a retirement plan, and that could afford you the opportunity to make tax deductible contributions, contribute way more than you can in an individual retirement account.
Absolutely. Yeah. So that's I would throw in there too, Bill. The biggest thing which you began in this conversation today about rebalancing, but if you're not sure and would like the help of a financial professional, and it's interesting, Bill and I are in the advice business. That's really our only product. And a lot of our viewers may think that this is easy. You own an index fund, and I just put my money in an index fund and I made 27.3. Okay. Well, the markets, whether we're talking about days, weeks, months, or years, typically the markets go up 2 out of 3 and they decline 1 out of 3. But as I pointed out before, we've had very lengthy periods of time where we had secular issues like 1966 to 1982, where all you really got was dividend yields in the stock market,
Right.
and you needed the help of a financial professional. And I think you could argue when you look at U.S. debt to GDP. Bill's made a wonderful spreadsheet if anyone would like to see that about the state of affairs with our nation financially, the balance sheet. We've got $30 trillion in debt. We've got huge debt to GDP that in the last 10 years has more than doubled, or approximately doubled, I would say. We're at 62% debt to GDP when Obama took office, and we're well over 100
Yeah.
right now. Okay, so here's the thing. It's interesting to talk about the year in review. What happened? What did we do? Where were the gains made? What didn't work? What's in store for 2022? What's most important? I think the most important themes that are going to play out next year are the virus, and I think this thing is, as we've had Omicron, even though yesterday the most cases ever reported in history with COVID-19 occurred yesterday. But Omicron, not to take this lightly, we have clients here that died.
Yeah.
It appears to be much more virulent, but much less lethal. And as long as we continue on that trend, and with people getting vaccinated, this thing is not going to be so impactful on the economy, I think, in 2022 as it was this year and last year. So, but the other major themes are the biggest single theme, or what to watch, is what is Jerome Powell and the Federal Reserve going to do?
Yep.
Now, they've already stated that they are accelerating tapering, and what that means is, they have been purchasing $120 billion a month in mortgages and U.S. Treasury securities, essentially buying those things from us and institutions, and they're going to unwind their purchases within the next few months at an accelerated rate, maybe completing this by the end of March or the end of the first quarter. And then they will be tightening the Fed funds rate to combat inflation, which they've only recently acknowledged to be, problematic. But, I read a story today. Omicron has gotten, and we don't know, this thing could keep on going. I mean, I would think that it's soon going to be peaking here within a few weeks, just by looking at Europe and South Africa. But, if the next one comes out, or what if it's worse, even Omicron, I'm reading, could delay actions by the Federal Reserve. And they've come up with a multitude of excuses to keep easy monetary policy in place and to keep the party going. And they have the appearance of being more political, to me, now than in years past. What do you agree with that, Bill?
I agree with the statement about the Fed, all eyes on Jerome Powell, the Fed chairman. And, we know it's undeniable that the Fed intervention in the markets that began in the aftermath of the credit crisis has buoyed financial assets, stocks and bonds. And we also know that when the Fed starts tightening policy, even in the years after the credit crisis, we've seen this. The Fed will start to try to raise interest rates, short-term interest rates, and when they do, the markets vomit. The markets have become too accustomed to easy monetary policy, and we have a question from a viewer about, at what level of Fed rate increases will the markets get affected? We don't know. The market is expecting rate hikes of around three, likely three next year. The Fed has signaled as much, so it's priced in, but it doesn't mean that the markets won't revolt, vomit, for lack of a better word, once we start to see these announcements. And it there's not a quantifiable way to determine when and if the markets will respond to the level of interest rate hikes. A lot of it has to do with sentiment, and it doesn't take one identifiable pin to prick an asset bubble. It could just happen, and just because people just say enough's enough.
I think that there are broad ways to try to evaluate that, though, Bill, because if you think about it this way, and I'm agreeing with exactly with what you said, but these different asset classes that we own, like the two broadest ones, stocks versus bonds, they compete with each other for capital. And at what point would we find treasuries to have very attractive yields? And so that way, like, remember, we have most of our large clients are in the oil and gas business, or many of them are a significant percentage, and they put their risky money in the ground, and they used to buy tax-free municipal bonds because the yields were very attractive, especially when you factored in that you didn't have to pay taxes on the interest earned, both federal and state, if they were Louisiana. But with yields falling to 1 or 2% or less, I found that most of these people haven't wanted to allocate to that. But you could see an allocation from stocks back to bonds if yields got high enough.
Well, sure. Well, I'd say this. We know we've gone from a period of investment to speculation, right? Would you agree with that?
Totally.
Okay. And
it's been too easy.
It's been too easy. And I would say one of the reasons why we've had this increased speculation through margin, investing in a margin, and options. Options trading has spiked as a percentage skyrocketed, as a percentage of overall equity trading. Why is that? Cheap money. Okay. So with interest rates as low as they've been, it has fueled speculation. So when the Fed starts tightening and raising Fed funds rates, all right, margin interest rates go up. And so you're likely to see curtailment of the speculation. Now, this is at the margin. So I think that we'll see less speculation in the markets.
Of course, you see a slowdown in things that are very economically sensitive, like building houses, housing with higher interest rate. You see at the margin fewer people refinancing stops. Then people, at the margin can't afford the houses that they want because rates are too high for the mortgage payments. And so that's it's going to be interesting because the Fed has already outlined these policies, and we don't know the NASDAQ would be the most interest rate sensitive to me because it yields the least and trades at the highest PE ratio, or price to earnings. So if interest rates go up, that's a long duration asset class, more volatile,
More
and
speculative.
more speculative, higher duration than long dated bonds. So that, that makes the case for value stocks, low price to earnings stocks, stocks that trade at low multiples of accounting based metrics like, PE, price to book, free cash flow to enterprise value.
I mean, this
Um,
2022 could be the year of boring is better.
yeah, yeah, I think so.
But
But
just know this, and I'm speaking directly to the viewer who asked. It was a very fine question. We don't know for certain, but just know this: 2022 is the year of regime change. Okay, monetary policy regime change. It's been announced. It's coming. Absent something shocking coming to the economy that would force the Fed to continue putting a net under the markets. So it's coming, and we will have to see, how the markets will respond to the decline in monetary policy stimulus. The other thing is fiscal stimulus. Okay, um, there's been so much fiscal stimulus pumped into the system in response to COVID.
yeah, and
We don't have it.
it looked like we were going to get a lot more. And well, there is still fiscal stimulus ongoing with things like the expandation of the child tax care credit, which I think has gotten absurdly out of hand. I mean, in my view, there should be means testing for things like that. Doctors making $500,000 a year should not be getting the child tax care credit for, all of their children. But so there's the fiscal stimulus is dissipating,
Mm-hmm.
and we were about to the Build Back Better package was going to be a huge one that I think likely would have kept the party going more, likely would have added to inflation, and it looks like that looks completely dead
Yeah.
with Manchin, opposing that. And I actually think that's a good thing that we're not getting that based upon inflationary levels. And
And this is just
yeah,
my opinion. I think that had that passed, that would have been more symbolic than anything, because we know that even with approval of a big congressional legislative package, that the monies aren't going to flow through to the underlying economy right away. There are no shovel ready projects waiting for a check from Washington. Those disbursements would be done over many years. But it sounded good.
well, I'm wondering if Bama has scored multiple times. Um, well, we here at Eagle Financial wish you the very best. That you would prosper financially and in health, and in this upcoming new year. If you've heard anything that really raised any kind of questions, we'd welcome a phone call to have a financial review with you, and talk about rebalancing and areas of the market that look most appealing as we go forward. And that's really pretty close to a wrap, I think. Bill, do you have anything else?
No, it is a wrap. We wish you all the best, and we will see you next year.